great to have you on the show with us, particularly on what looks like kind of an historic Fed day, a 75 basis point hike up until a couple of days ago. It wasn't even expected. Looks more aggressive. Is the Fed being aggressive enough? Is this a move in the right direction?
It is a move in the right direction. It's a big step today, taking everything considered about the meeting together in the direction of greater realism. Their inflation forecast for this year is 5.25%, much more realistic than what they had written down. The unemployment rate is forecasted to rise a bit, and their federal funds rate path is higher and significantly more realistic. Nonetheless, their projections lie at the very outer edge of credibility, in my view. The inflation rate falls to 2.5% next year. The unemployment rate never gets above 4%, or at least the median doesn't until 2024. And the federal funds rate only reaches 4%, just clips that at the end of 23 before falling a bit. This is a best case scenario. A number of things that are outside their control have to break in their direction. Supply chains have to heal themselves pretty smartly, and wage rates have to decelerate pretty smartly as well. I think that they're going to find later this year that it's going to take more aggressive rate hikes in order to do the job.
So how aggressive then, Jeff, will they have to be? How high is the funds rate going to have to get, and how quickly is it going to need to get there?
So I think it's going to have to go to about 5.5 or 6%. That's my own sense, and that's based on just the historical record that indicates that real interest rates, inflation-adjusted short-term policy rates, have to get above zero in order to have any chance of restraining inflation. The Fed's policy rate is deeply negative on an inflation-adjusted basis right now. In order to get it into positive territory on that basis, it has to get above the current level of expected inflation, which indicators suggest is around 5.5 to 6.5%. So they're going to have to raise it pretty smartly, I think, and continue raising it into next year.
Smartly is a key word, right, Jeff? Can the Fed do that without crashing the economy?
I don't think so. I think I said a couple months ago, I think they missed the opportunity to do this without a recession, without a significant increase in the unemployment rate. I may be wrong. I'd love to be proven wrong, but I just don't see how that can happen, how they can restrain demand enough to pull back inflation without causing a significant downturn in the labor market in the U.S.
Is the late start also feeding into this negative loop where it seems like the blunt tools that the Fed has are now maybe feeding more into inflation expectations? And at the same time, do these policy tools actually have much of a chance of working when it comes to combating energy and food prices?
So ultimately, they will have the potency they need if they raise rates enough. But you're right to point to the delay last year as hamstringing them this year. I think that the fact that they took so long to get on top of this and start moving till March this year, I think has let inflation expectations become more embedded, at least for over the short-term horizons, and it's encouraged wage rates to rise at a more rapid pace to make up for past inflation. So I think we have embedded wage inflation that's going to keep price inflation up at an elevated level in the near term as well.
You know, Jeff, the people are looking a lot at financial conditions. They're looking at the fact that the balance sheet reduction is starting now. How much of a lift is that going to give the Fed, and how much do you think they're counting on that? Because you think the funds rate has to go a lot higher than the median group at the Fed does.
I think the balance sheet is sort of a sideshow. It's large, and they're reducing it at a decent clip. They could go much faster. And some Fed officials have hinted about the possibility of needing to resort to actual outright asset sales. And I actually think that would be a good sign if they did that. I think if they started selling, in particular, the mortgage-backed securities, there's no earthly reason why they should be providing stimulus to the housing market at this point. The housing market's clearly overheated. That's one sector of the economy where they need to ratchet down demand. But I don't think that the effect on overall economic activity is large enough from the type of balance sheet adjustments they're contemplating to be a material factor here. I think the interest rates are where the game is.
And Jeff, this insistence from Jay Powell that a soft landing is possible, even as more and more voices say, hey, even if you don't get a real recession, you've got to have higher unemployment and much slower demand, and that's not going to be very soft. Has something changed since the Volcker years? Is it tougher for the Fed now to send this signal of doing whatever it takes, especially so close to a midterm election, especially at a time when inflation has become not just a monetary policy hot potato, but a political hot potato as well?
I think they're walking a fine line. I think that they're expressing their determination, their commitment to bring inflation down. They've said in the past they believe they can do it with the soft landing. They're going to try to do it with the soft landing. I think they've backed away from that a little bit in this meeting. In fact, they dropped a critical sentence. The sentence basically said that they believe that with appropriate policy, they can bring inflation down and maintain a strong labor market. They deleted that, indicating they're not certain they can do this soft landing. That's an indication that they think they're running the risk of a recession. Their commitment to reducing inflation means they're committed to running the risk of causing a recession to get that done. They've been inching up to that opinion, inching up to a statement like that. And I think they did an adroit job of rolling that out. And we'll see if that sinks in the marketplace.